So many people have been focused on growth, and that is working well. If you were retired and your stock values were going up, that's wonderful. But as that weakens, having those assets where they can generate income, real estate's a good example.
And welcome into another edition of Your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for your money, your finance, your investments for your retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us. We always appreciate the time, the insight, the knowledge that you share, Chris. A very educational program, ladies and gentlemen, teaching you what to do or think about or the strategies that are available to further your progress towards your financial goals. We always appreciate the insights that Chris shares. And Chris, you usually start us off with a tip of the week.
Yeah, tip of the week here is, cash flow is in retirement is more important than the account balance. And what I mean by that is, if you're invested in a portfolio of dividend paying stocks or interest paying bonds, you don't really care what the price of those stocks are. You care about, the reliability of the dividends they're paying. That's the difference between income stocks and growth stocks. Nvidia might be the hottest thing in the world today, but if the price of Nvidia drops 20%, they're not increasing dividend payments. It's not a stock we use for income, if you will, as an example.
Chris, I think that's a great point here. And it's counter to what we have been taught and how we have been trained to think about our money. It's like a contest. Who's got the biggest balance? Oh, well, he's got more than me. Well, but at least I've got more than him. And I think I've saved enough. I've got a good nest egg. But this is all relative to the account balance, not the income that it'll produce.
Yes, absolutely. So like, here's an example, I like dividend paying stocks for my wife and I's personal money as well. And, I want some growth also, but it's the reliability of those dividend payments. So, let's just say, for example, pull a number out of the air, $1 million, and you're getting 5% on that money in dividends and interest. That's $50,000 a year. If you don't need it right now, you're reinvesting. That's almost $4,000 a month that you're reinvesting to average it out over a 12-month time frame. It's almost like you're making contributions. So, Peter, you and I have talked previously. It's like, look, I use those dividends and buy riskier stocks. I'm not upsetting my portfolio. I want that baseline of those high quality dividend payers. And they'll have their day in the sunshine. And last year for 2025 wasn't the best year for dividend paying stocks. Okay. But to start this year off, as the AI trade has weakened a little bit, dividend stocks and all that are doing fantastic.
Over a long enough period of time, everything seems to be cyclical. Things come into favor and out of favor, and what's hot one year does not seem to remain hot forever in the markets. And that's why we need a good diversification, different asset allocation, different asset location, but most importantly, again, the balance, the lump sum is not the answer to the question of do I have enough and can I have a comfortable, confident retirement? That's all about the income that you can generate and count and depend on. And that's why when Chris McIntire puts together the game plan for retirement, your game plan for retirement for you, ladies and gentlemen, he focuses on all of the pieces working together. How to create that lasting financial confidence through the perspective of income, investments, taxes, healthcare, legacy, making sure that all the parts are cohesive, fitting together, one picture, helping you work toward your important financial goals. And if you would like to get that game plan for retirement, again, your game plan for retirement, specific to you and your goals with long-term vision, diversified strategies, pick up the phone, give a call. That is a complimentary, courtesy, no cost, free of charge service that Chris McIntire offers as part of the program, as an extension of the information here on the show. So to get that conversation started, 419-332 0532, 419-332 0532, 419-332 0532. And Chris, assets are not the same as income. And that's why, even though this generation has saved more than any previous generation, still the most common number one question and concern: have I saved enough? Do I have enough to last me through retirement?
Yes, and especially given the recent years in this market cycle, Peter, as so many people have been focused on growth, and that is working well. If you were retired and your stock values were going up in this artificial intelligence or technology play, that's wonderful. But as that weakens, as markets do over time, having those assets where they can generate income, real estate's a good example. If you have rental properties, that is an asset that can provide income. Not all assets, though, do provide income, Peter. And, so, we want to look, some people have business ventures, where, you and I run a business, our business has a value, okay? But nobody gives us money for that until we sell it. We obviously make money while we're working in it, but, we probably get a bigger payday down the road when we sell that business, and then we can, use those proceeds to generate income. People have 401ks, IRAs, brokerage accounts. Those are good example of assets that, not necessarily create income. Annuities are income creators. That's what they're designed to do. And, some of them pay money out immediately. Some of them allow you to choose when you want to take the money out. So you're deferring the income. Just a couple different examples, of assets and income producing assets as well.
And of course, assets matter. They are the store of capital to provide the income, to draw that income from. And you gave a good example of several different types of assets, from the traditional retirement assets, those 401ks, those IRAs, business interests, real estate, brokerage accounts. But we do tend to focus on the balance. That's at the end of the month when we get the statement, the bottom line, what everybody is trained to look at until, Chris, we make this transition to retirement. And like any story, starting at the beginning, what is income and why is it different? Those assets have always depended on the income that we were generating, and in fact, been built, been possible because of the income that we had during our working career.
Yeah, yep, without a doubt. Some examples here, what is income? Why is it different? Like if we look at Social Security, we've been paying into that. That's an income producing asset. They've been taking that money out,
But
right?
people don't look at the lump sum on Social Security. They look at the income. Like we've been trained on that a different way, and we think about that a different way because of it.
Yeah, exactly. And I have these conversations, because we always go back and forth with clients. Everything's got its pluses and minuses. And, I run into people that say, well, I really don't like annuities. I'm like, all right, so what do you do with your Social Security? He said, well, I use it for my living expenses. I'm like,
I
well,
spend it.
yeah, well, guess what Social Security is? It's an annuity, and so is your pension. So many people, again, everybody's situation's different, of course, here, Peter. And, we create income portfolios that don't have an annuity in them, for example, for a client that says that is adamant about that. And that's okay. That's what our job is. And, so that's where we use the dividend stocks. We use some structured notes through our partners at Brookstone that are good income generators, bonds, covered call options and things like that are better at producing income than maybe doubling in value like Nvidia stock or Amazon, for example.
But there is a spectrum of risk there as well, right? Chris, is like you are moving kind of up the ladder of risk as you are talking about some of these various options. Social Security, of course, we all count and depend on and rely on being there, backed by the full faith and credit of the U.S. government, considered kind of the safest source of income in retirement, and then pensions and interest bearing accounts and annuities, and then you're getting into more of those dividend stocks and structured notes and things like that. It's got to be catered and customized to our needs, wants, and comfort level with the risks that we are exposing ourselves to, and then we're playing the chances of probability versus certainty in some cases. Yes, there's a probability these things do well, but there's also the possibility they don't versus the certainty that is available with other instruments.
Yes, yeah, yeah, without a doubt. If an annuity's got a contractual guarantee. Your pension is supposed to be very well funded. Social Security, and I suppose we can laugh about it. We read our statements, and it's got some uncertainty, and hopefully we're hoping the government corrects that. And let's put that to the side for now. But if you're investing only using stocks and bonds, those have risk. There is no guarantee contractually that they're going to do what you want to do. So, that's why you offset some of that risk. You don't put all your eggs in an annuity, 100% of your dollars to get X number of dollars every month for as long as you're alive. You put it into a portfolio that allows you to and use enough of it to help cover your basic living expenses is very common, right? I got Social Security coming in, I got an annuity payment coming in that covers my basic living expenses. And then I've got an investment portfolio where I can now either choose to, have some dividends come in, but also maybe your long-term growth so that you can pass money on to your kids, combat inflation, and experience, hopefully some long-term financial success. And, you can play that off with adding some bonds to the portfolio to cushion some of the downside based on your overall risk tolerance.
Sure, but cracks are going to form over time with the inflation and taxes and market volatility. And Chris, the day after retirement, the bills don't stop, right? And the bills are paid through cash flow, not the lump sum bottom line balance that we see on our statements. But that's what we've been trained to focus on. Why is that confusion and misguided focus so common, do you feel, in your opinion?
Uh, you know, there's a media bias that is out there, of course, that drives our decision-making process. And, some people just truly don't understand what portfolio construction is all about. And, you watch CNBC, Fox Business, Bloomberg, whatever they're talking more about individual stocks. They don't necessarily break down, constructing a retirement portfolio, and you don't hear them talk about the insurance industry unless they're talking about United Healthcare stock price, and that's a health insurance company. So, I just think is I would call it misinformation. I'm not going to use the word disinformation, but obviously we, in our world that we live in today, I think we all read the news and then put it through the filter, right?
Hmm. Yeah. But I mean, so do you think it's somewhat Wall Street training and marketing that has gotten us so focused on the lump sum, but on the other hand, maybe during our working career, we know and can quantify our income, and that lump sum number is more quantifiable, like we can see where we are and use that as a gauge of barometer?
Yeah, yeah, I think that's a fair question, and we'll take the run up in gold and silver here. I mean that's just pure growth. They don't pay any dividends or anything, so you have to sell that off to create your income. So that's a good example of growth versus income. And we also obviously here, Peter, live in the investment world where people have FOMO, the fear of missing out. So gold, silver's up, a couple 100% over the last year, as much as 300%, depending on when you're measuring it, but then recently it had a 1 day decline of 30%. Well, how many people do you think, bought it up there toward the top and now they lost 30% and probably hit the sell button already?
I actually heard a lot of the gold dealers, the coin shops, the places where you can transact, put a pause on turning bullion and coins back into cash because of the quick volatility of how fast that price has been moving, Chris. So, at some point in time, you buy gold, you see that it's gone up, and you're saying, "Hey, I've made a profit here. Let me turn this back into cash." That might not be as quick and easy a process as you might hope and imagine.
Yeah, you're absolutely right. And, Bitcoin, for example, is another one, that, older people are starting to, it's easier to buy Bitcoin and other cryptocurrencies in using exchange traded funds that Wall Street offers. And I personally bought some, after it fell 40%. It's like, all right, it's probably a pretty good buying opportunity. And that was my first foray into it. And, it'd be a long-term holding, very small fractional piece of my overall investment portfolio as well. But, I figured, all right, it's here, it's in mutual funds, exchange traded funds. It's not going to evaporate, in my opinion, at least.
Yeah. Well, retirement requires turning assets into income stability and requires intentionality to do that. And that's why, ladies and gentlemen, you need to focus and refocus the attention and the planning purpose when you make that transition into retirement. And that is what your game plan for retirement is all about, is making sure that the assets fit in with the income that you need to rely on, that you are controlling your taxes, that you understand and have addressed medical cost, and ultimately that your legacy is built the way that you intend, bringing all of those pieces together, not simply a focus on access to the investment world. Yes, of course, that's a very important component to your financial progress. But that part, Chris, has become a little bit more commoditized and democratized. If all we are doing is saying, hey, here are mutual funds, that is not the whole picture. And that's why I think you stress the importance of having this game plan for retirement, bringing those pieces together, painting the full picture, unique to an individual's goals. And ladies and gentlemen, again, if you would like to get your game plan for retirement put together, or just have a few questions and want to see what you might be missing in your current plan, pick up the phone, give Chris McIntire a call, 419-332-0532. Have a conversation, 419-332-0532, 419-332-0532. Here's kind of the central challenge to retirement then, Chris, is that you must create that paycheck from assets that were never designed to create a paycheck. I mean, you talked about a couple that can, but there's really many assets that we're utilizing that are not designed to create a paycheck or an income.
Yes, and I mean, this is a real challenge to try to highlight and drive home the importance when we're talking to prospective clients or current clients that are switching from growth to income, is to say, look, we need the reliability here. I mean, we have some things. We got obviously Social Security, pensions, and you can have annuities that have contractual guarantees in them, backed by the claims paying ability of the insurance company. But other things are variable sources of income. Dividends aren't guaranteed. Interest isn't guaranteed. Your rental income isn't guaranteed. Somebody vacates the house and, does $20,000 worth of damage. Now you're going the other direction, obviously. So, all these things have their risk associated with them. And that's why it's nice to create that balanced portfolio where, look, you've got your basic living expenses covered, so that if, everything in the world, comes to an end, for example, like look at April of 2025, the market falls, 15 to 18% in there, off those tariffs, man. And look what happened to the value of portfolio in a 30-day time frame, basically. And now, thankfully, we ended up at record highs and whatnot. But there are a lot of things that can happen. We have not had a steep recession in a very long time, Peter. I mean, we're going back to 2000, 2001, 2002, where, we had that prolonged sell-off in the markets. 2020, we had COVID. The government stepped in real quick. We can obviously go back to 2008. We had the financial crisis with the real estate. The government came in and helped shore up the financial system, and a pretty sharp rebound after that. And then we had the 2020, 2022, yeah, when the interest rates went up 11 times in a row. And still, we didn't go into a recession. And, right now, tax cuts in place, companies beating their earnings by and large. I mean, like 85% of the companies are beating their earnings estimates, so those are signs of a pretty bullish economy yet. So let's hope it continues. And it gives people a chance that are retiring right now with their greatest 401k values, is to say, hey man, you've done fantastic. You're up 250,000. Do we want to shift a little bit of that over here and talk about creating income out of that, and let the rest of it do its thing still?
Yep. And we've been taking advantage of that, Chris, by and large. Like the most common tool is the 401k. That might at certain points in time transition over to an IRA, right? But those have been those accumulation vehicles that we have utilized. They are available. They're easy to access. They're easy to utilize. They take advantage of dollar cost averaging. Great tools that are available to us for accumulation, but they don't offer guarantees and certainly not guaranteed income. They require withdrawal strategies, risk management, tax planning, and those are the components that get overlooked the day before retirement, the day of retirement, the day, the year, the decade after retirement, and can put the trajectory of retirement in jeopardy. We might not feel that initially, like not in the first day or month or year, but eventually that additional risk, the fact that these vehicles are not designed, they don't put the first few years of retirement in jeopardy. They put the last several years of retirement in jeopardy.
Yeah, yep, absolutely. I got a 92-year-old dad and 88-year-old mom, and obviously they've gone through some challenges in those time frames and whatnot, and now it's health challenges, of course. So, like Peter is talking out there, let's say we've got, a number of different things that we're facing here in retirement, and taxes is going to be one of them. Most people have been putting money into their 401k, they roll it into an IRA. They pull money out of that. Now we have to deal with the tax situation there. So, you got $1 million IRA. That doesn't mean you're going to net out $1 million. You might, if you pull out $30,000 a year, we've got going to add that to the taxable piece. So, you have that factor. I have some clients that have, a number of rental properties, and there's a liquidity issue, obviously, with real estate. If you actually physically own it, if you need to get rid of it quick, you got to wait for a buyer. So, you don't want to go too heavy into the illiquid side of things. Even the annuities that provide the income, those aren't considered the most liquid investment. So that's why you balance this portfolio out with instruments that, you got your emergency fund, and a lot of times people are using that at the bank, a CD, extra savings, money market accounts, and then they create their investment portfolio, and maybe they take a monthly draw off of that. They might have their annuity where they're getting their income, and then, Social Security and pensions, and again, Social Security, the timing of that. Some people retire at 62. They don't want to take Social Security to 67. So we need to fill that income gap sometimes for a 2 to 5 year time frame in there, because they want to maximize their Social Security income. If everybody in the family, I'm looking at it right now. I got a 92-year-old dad and an 88-year-old mom. I don't want to take Social Security at 62, obviously.
Yeah. Uh, Chris, income planning is risk management. It helps address those factors that you talked about: market downturns, inflation, longevity, unexpected healthcare expenses. And we can have a large net worth and still feel financially stressed. I mean, somebody with $2 million portfolio, but does not have an income strategy, someone with rental properties, but no liquidity, a person with large IRAs that has not quantified the tax bill that they will pay. All of these factors play in to wealth not equating to spendability, not being the same as income. Liquidity and income determine freedom and confidence in retirement. And I know that's what you try to help people build: freedom and confidence with the plan, with the game plan for retirement that you put together.
Yes, and it takes an education process a lot of the times, because on an income portfolio, I'll use 2025 as an example. If we've got a portfolio of $1 million and we paid out $40,000 in dividends, okay, the client didn't have to sell anything off. Okay, well, what if the prices of those stocks went down? Okay, yep, that happens. It's the reliability of those dividends. So, as this market ebbs and flows from growth, value, income stocks, all of those things, your performance is going to ebb and flow as well. And that's why it's so important to understand why you own what you own. An income portfolio is a hell of a lot different than a growth portfolio,
Well,
and it doesn't mean you can't have both.
Yeah, I think we should, right, Chris? I mean,
Sure.
that's the key is balance. We started the show talking about how the tech high flyers were in favor, and suddenly they're not so much. But the dividend producing stocks and the value stocks were not, and now they've started the year off on a pretty good foot. So like, we've got to have that diversification, and too often we're focused, and a lot of people out there probably listening to the program, Chris, are kind of all in one type of fund that targets a certain date or has a specific year that they intend to retire, but they don't have the true diversity even with that fund that is supposed to theoretically help control risk.
Yeah, and let's do a Super Bowl analogy here. Seattle versus New England. I mean, it wasn't offense that won that game for Seattle. I mean, all they could do was kick field goals. It was their defense that stifled New England, and I was pulling for New England in all fairness. And I did, and I turned the game off at three-quarters of the way through it because I thought, all right, this game is over. And let's be honest, it was boring. Playing defense can be boring, unless you're a master of the game and you're watching the strategies. Most of us want to see, some long catches and things like that. Those defensive struggles aren't always what everybody's flavor is.
No, but sometimes, Chris, the defense wins championships, as we saw in the Super Bowl and as we have heard so often in other sports analogies that equate to our financial well-being as well. Building a true retirement income plan is that defensive strategy. And the big takeaway is that assets are tools and they are important tools, but income is the outcome for why we have been saving and building those assets. But if you don't have a specific plan for how to turn the assets into income, you are missing one of the most important components of a confident retirement, Chris.
Yeah, yep, you certainly are. And we've talked about this throughout the years, Peter. 10 years or so you and I have been doing this is, just retirement is about creating income for most people. If you're a blessed school, husband, wife, school teacher, right? You got pretty good pensions here in the state of Ohio. You're probably not relying on your 403B, for example, but if you're been working construction and some of the, the middle class jobs that we have here, hardworking people, they don't have the pensions. They have those big 401ks, and, growth got you there. Income is going to finish the game for you in most cases.
Well, McIntire Retirement Services, they put together your game plan for retirement to help savers and investors better determine your outcome, ladies and gentlemen, make your goals your reality. So some of the common goals, if you would like to produce more income more consistently, dependably, pay less in taxes, have less risk, address longevity, healthcare expenses, have a plan that provides for lasting outlook for confidence into and throughout the years to come. Pick up the phone, give Chris McIntire a call, have a conversation, and set up a time to put together your game plan for retirement. 419-332-0532, 419-332-0532. Again, 419-332-0532, or you can go online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. Chris, it is always a pleasure. Thanks for this important conversation and reminder of what is going to build and drive our lasting financial confidence.
Yeah, my pleasure. Yep. Thanks for listening, everybody. Be safe out there, and may God bless America.
Tune into Chris McIntire's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.